Let's continue topic 2. We will introduce some of the very simple strategy in constructing investment portfolios. We will use China Baijiu industry as example. The topic question here is, what is an investment constructing strategy? In order to construct an investment portfolio, we have to determine two things. First, what are the members or the components of the portfolio? And then after we have chosen the members of the portfolio, what are their proportions or percentage? Well, different percentage may have different return and different risk. And our purpose is we look for higher return, and in the meantime, we look for lower risk. That is the fundamental purpose of constructing investment portfolios. Okay. For example, for the China Baijiu portfolio, we have all these portfolio members or components, and these are proportions. This is the current proportions or the current percentage. But we don't know whether these combinations is the best in terms of higher return and lower risk. So now we can have a criteria for a good investment portfolio, okay, which is higher return and lower risk. This is our current proportion, but we are not sure whether it fulfills the criteria. So we can do some tests. This is a quick test. Well, we have a couple of portfolios here. We have 3. And the blue solid line is our current proportion. It is here. We have a name for it called My Portfolio. And this is the date. This is the holding returns. We find that in terms of holding returns, suppose our investment starts on July the 1st, 2020, and we hold it till 2021 July. And we find that our holding returns of my portfolio is not as good as the other 2. So what are the proportion of the other 2? We have equal weight and OM cap. I'll explain later. At least we find in terms of holding returns, this one, equal weight, EW, this one, OM cap, are all higher than that of my portfolio. That means, in terms of holding returns, my portfolio need improvement. Let me explain our strategies. First, we have a very simple strategy in constructing investment portfolio. It is also called the simplest strategy. And this strategy means every stock in a portfolio with equal weight in terms of proportions, number of shares, equal weight. Means, for example, we have Maotai and we have Wuliangye. This portfolio means we have same proportions. This is the simplest one. However, even by this simplest one for constructing investment portfolio, its holding returns is even better than our current one, my portfolio, right? Well, it doesn't mean a general rule, but it's the case. It's the case here. What about OM cap strategy? OM cap strategy is I think also a very simple strategy, simply leverage on the market value of a stock. Okay? We use the outstanding market capitalizations, called OM cap, of a stock as the weight in the portfolio. For example, 茅台, 五粮液. If Maotai's market value or market capitalization suppose is 200 billion RMB, and Wu Liangye suppose is 50 billion RMB. So we use this as their proportional percentage, right? For example, if we have an investment portfolio just with two stocks, Maotai and Wu Liangye, so by OM cap strategy, we have their market capitalizations. So Maotai's percentage would be 200 billion divided by 200 billion plus 50 billion, right? That means 250, this is 200, and this is 5, this is 4, okay, 80%. Maotai 80%, Wu Liangye 20%. So this is called OM cap strategy. It's also very simple. It depends on which market capitalization is bigger in market. The bigger the market capitalization, the more the proportion of a stock in the investment portfolio. But does this stock work well? Not sure. It is just a strategy. Let's look at the picture here. Okay. This one is the OM cap strategies holding returns. Its performance is between my portfolio and the equal weight portfolio, but it is not a general rule. It's just an occasional phenomenon. But it means that even we use OM cap strategy, it also needs improvement. So actually, all these strategies need improvements, including my portfolio as well. Okay, my portfolio here is a starting point for us to optimize investment portfolio. We will show you better strategies to optimize investment portfolios, but we need theoretical support. So relatively, usually, OM cap portfolio strategy is a relatively conservative one. Yeah. As the stock with bigger market value usually behaves less volatility in return, means stable, or steady, or stable, right? So that's why we call it relatively conservative. In order for a better investment portfolio strategy, we need theoretical support. And the theory here we are using is called MPT. MPT theory was introduced by a guy called Harry Markowitz in 1952. Of course, later this guy won Nobel Prize for Economy. And MPT is a theory about portfolio construction. So you may have a question, what does MPT stands for? MPT stands for Modern Portfolio Theory. Okay, this is easy to understand, right? And the purpose of the theory is for lower level of risk, and in the meantime, for higher level of return. We look for the simultaneous situation with higher return and lower risk. In the meantime, in order to introduce MPT theory, we need to understand 4 key concepts. First is the risk preference, and then hedging. We have introduced some of them. And then we know efficient set, or sometimes called feasible set. And then we learn a very useful concept. It's called efficient frontier. Let's look at the investor's risk preference first. Investor's risk preference. We have introduced something previously. First, we have 3 basic types, very basic types. Of course, you can have more types in more details. The first one, very common, conservative. So what is called conservative? They prefer to lower risk. Well, in order for a lower risk, they are willing to accept lower return, right? So they focus too much on lower risk. And then we have another type, the opposite side, called aggressive. Aggressive, they prefer to higher return. In order for higher return, they are willing to accept higher risk. Very aggressive. And in between, we have risk neutral. Sometimes we call them prudent. Prudent is between these two. Okay, they look for a balance between return and risk. That means for every risk they undertake, they expect higher return. Again, for every unit of risk they undertake, they expect higher return. But they are not looking for the highest return, and they are not willing to accept the highest risk. And instead, they want a good balance on that. These are the very basic three investors' risk preference. So we can imagine that for conservative investors, their portfolio usually would be with lowest risk. Would that be lowest return? Not always. They expect lowest risk. In the meantime, under the base of lowest risk, of course, they look for higher return as well. So their return may not be always the lowest. And for aggressive guys, their return usually the highest, but usually accompanying with highest risk. Of course, while they are looking for highest return, they are trying their best to lower down their risk as well. The third type, prudent, is very different. They look for, we call them better balance between return and risk. In other way, they would like to look for a better ratio between return and risk. Suppose we have a ratio like this. So this is about the investor's risk preference. Then we have more things to talk about hedging. A similar word to hedging is called offset. Offset what? We do not expect to offset return. We expect to offset risk. And in the meantime, we do not expect to decreasing the return too much, right? In the meantime, we expect to offset risk by hedging sometime, and in the meantime, we expect to keep our return. So hedging is a very important concept in constructing a portfolio. Okay. Its idea is to spread risk in the portfolio. We spread one risk point to the whole portfolio. So this is called risk spreading. Technically, hedging is a technical method to blending diversified securities with adverse price movement in market. For example, we have A and B, two stocks. If we can find two stocks fulfilling the following situation, that if stock A stock price goes up, stock B goes down. Stock A goes down, stock B goes up. So we call this adverse price movement. And we call these two stocks as diversified. Diversified here means very different. Examples, we can have the following adversely pricing security, such as cyclical stocks, such as aircons, such as mooncakes, right? Or sometimes we call them seasonal products with counter-cyclical products, such as utilities, water supplies, gas, fuel, okay. A fuel-based vehicle and electric-based vehicle. So we have a lot of new brands for electrical vehicle, call them NEV, right? New electric vehicle vendors, such as we have 蔚来, okay, we have Xiaopeng, and we have such as 比亚迪, okay, these are all NEV stocks. Of course, you can choose the industry NEV to do your module homework. And also we have stocks versus treasury bonds. Usually stock market and bonds market, they move adversely. Usually when stock price goes up, bond market goes down, right? Stock market goes to bear market, bond market goes to bull market. This is pretty interesting. So that's why sometimes some of the investment portfolios, they expect to blend stocks with bond. Blend stocks with bond. Yeah, sometimes. So this is hedging. Okay, in order to construct the China Baijiu industry, you choose a lot. But as I have limited power of calculation in my computer, so I cannot include too many stock members in the portfolio. If we include too many stock members in the portfolio, in the case studies, we will need much longer time to do one case studies. Now you know the importance of a powerful calculation capability of a computer. Usually the CPU's capability is the most important factor in a computer, right? Nowadays, whenever we want to buy a new computer, we probably suggest you to choose the most powerful CPUs. Next, we expect to learn the concept called efficient set. Well, you can look at this portfolio, this graph, very interesting. We have a lot of dots here. Each dot represents a portfolio, an investment portfolio. And let me explain. For the previous China Baijiu portfolio, we have Maotai, and we have Wu Liangye, and we have Sui Jingfang, we have some others. And initially, we have a proportion called my portfolio. You can simply change it to probably Peter's portfolio or somewhat like that. And for each of the stock members in the portfolio, we have a percentage. For example, 20%, 40%, 20%, 20% or something. However, for this percentage, we may have numerous combinations. Of course, the lump sum of these combinations should be equals to what, right? That means 100%, 100%. So we can draw all these combinations together in a picture, in a figure, which is like this. This is the collection of these portfolios. Of course, for an investment portfolio, actually, or theoretically, we can have numerous portfolios with numerous proportions. Okay. But for a case study, we cannot do numerous portfolios. So this time we do 50,000 portfolios and we draw them in a picture, which is like this. We find that their shapes is pretty interesting. The more portfolios we have, the shapes gradually become this kind of shapes. And all the portfolio here, we call them efficient set. In some of the textbooks, they call this feasible sets. However, in these feasible sets, we have two dimensions. This one is the risk level. This one is the risk level. And this one is the level of return. In order to describe the level of risk, we use annualized standard deviation. And in order to describe the level of return, we use annualized return. Here it refers to holding returns. So you may have the question, how can I get these 50,000 different kinds of portfolios? We use a simple measure called random number, like throwing dice. And this method is called the Monte Carlo simulation. The Monte Carlo simulation. This is also a very interesting one. We use Monte Carlo simulation method. Actually, it's just a random number method to create what? The efficient set. By what? By the existing stock numbers in my portfolios. In my portfolios. We have my portfolios. We have 茅台、五粮液、水井坊, blah, blah, blah. Right? So based on my portfolio stocks. Okay. And then in order to calculate the level of risk and the level of return, we have to choose a period of data as well in order to have data for the portfolio price and portfolio returns. The period here is from the beginning of July 2020 to 2021. It's 1 year observation period. Yeah. Okay, well, we did this in 2020 to July the 2nd, just for this course. Now we can update the situation as well. So before we do that, we see two special areas. This area and this area. This area by red line and this area by blue lines. So what can you find out about these two lines? These are very special area in the efficient set. Let's look at this line. Okay, we have a line here, and these lines go through many portfolios, right? In all the portfolios in this line, we find that they have the same level of risk. While undertaking same level of risk, I believe that most investors would like to look for a better return. So for all the portfolios in these lines with same level of risk, which portfolio has the highest return? This one, right? This one. Okay, this is the level of return, and this is the level of risk. So if we connect all these points together, it becomes this line, right? It becomes this line. So this line is called the efficient frontier. You'll find out the interesting characteristics about the efficient frontier. It means if we undertake same level of risk, the portfolio in the efficient frontier will have the highest return, right? Well, on the contrary, let's look at the portfolio on these blue solid lines. We find that under same level of risk, the portfolio and these lines receives lowest return. So this is called inefficient frontier. So if you were an investor, which one would you consider first? The portfolio in the inefficient frontier or the portfolio in the efficient frontier? Which one would you choose? If I were you, of course, I will definitely choose the portfolio on the efficient frontier. Then let's look at it from another perspective. Say, for example, for the portfolios with same level of return, they are in this line, right? Okay, so all the portfolio in these lines with same level of return, but they have different level of risk. The portfolio here, they have the highest risk, and the portfolio here, they have the lowest risk, right? So now we find another explanation for the portfolios on the efficient frontier. Okay. The portfolio frontier means for all the portfolios with same level of return, the portfolio on the efficient frontier will have the lowest return. Sorry, the lowest risk. Let me summarize that. Efficient frontier. We can explain from two aspects. First, for all the portfolio with same level of risk, the portfolio on the efficient frontier will have highest return, right? Another perspective. For all the portfolios with same level of return, the portfolio on the efficient frontier will have the lowest risk, right? These two findings are critically important. So with these two findings, now, whenever we look for the best combination of return and risk, we will focus only on the efficient frontier, right? The efficient frontier. But even on the efficient frontier, we still have numerous portfolios. We still need to look for a best one. The one probably need to best balance return with risk. We will do something more about that. Okay. Now you know that the way we create efficient set, we use Monte Carlo simulation. Monte Carlo simulation means random number simulation, right? We can simulate the portfolios in efficient set using random number simulations. This is the two-way explanation about efficient frontier. That's the one. Okay. Given a specific level of risk with highest return, and given a specific level of return with lowest risk. These kinds of portfolios, we connect them together. We call them efficient frontier. A frontier is somewhat aligned, right? Well, this is another key question in Module 5, how to balance between return and risk. How to balance between return and risk. For example, for those investors, those prudent investors, they look for a best balance between return and risk. That means for every unit of risk they undertake, they look for a higher return, right? Otherwise, they refuse to invest, right? Now, in this topic, we will begin to learn a very important concept. It's called Sharpe ratio. Sharpe ratio. Of course, Sharpe ratio is proposed initially by a guy called William Sharpe, the person who proposed CAPM in the 1960s, and he won Nobel Prize for Economy as well. Sharpe ratio is one of the most famous tools in balancing return and risk. Our question here is, what is Sharpe ratio? A Sharpe ratio is also called the return risk performance ratio, right? Let's look at how to calculate Sharpe ratio. Okay. In order to explain how to calculate Sharpe ratio, we need to explain further on this. Now let's explain Sharpe ratio. In order to understand Sharpe ratio, we have to understand two concepts first. First, what is called risk-free return. Another one, we need to understand the concept called risk premium. What is called risk premium? Let's look at the first one. A risk-free return is a level of return you can earn in market without any risk. That means you can for 100% sure you can earn this return in market no risk at all. So think about what kind of this return is. It says, okay, suppose we have 1,000 kuai. We can save them in the bank, for example, for a time deposit for 1 year in ICBC, Industrial Commercial Bank of China. Usually we think ICBC will not go bankruptcy, right? So we think we have a 1 year deposit in ICBC would be risk-free. And then you have an interest rate about 2.5. So in this way, 2.5 is your risk-free return, right? However, in order to calculate the risk-free return, we usually look for the highest one. The highest return in market without any risk. So what kind of return is this? Let me think for a while. See you after 10 minutes break.